Hello and welcome to today's edition of Beyond Reasonable Doubt. My name is George Wong. In today's episode, we shall be looking at insurance risks. Again, this is Life Insurance Awareness Month, for those who don't know. Before we get into the details, I'd like to appreciate you once more, those who have been following along. If this is the first time you're here, last episode we were talking about the concept and purpose of insurance in general, and today we are looking at the risk. So there are two key things I want you to keep at the back of your mind as you follow in this particular episode. The first one is that complexity increases the risk, and the second one is that all risk translate into money, dollar, into cost. There will be an episode where we'll talk about the cost, but these things we cannot separate them. I just separate some of the topics for the ease of understanding. So two key things. The first one, complexity increases risk, and all risk translate into money. So keep that at the back of your mind. So let's dive into it straight. So talking about risk, I would like you to imagine this scenario. A single individual attempting to get into an insurance pool, into a community pool, to benefit from spreading the risk. So, and to go a little further, I would like to promote you watching. I will promote you right now into the coordinator of this pool, this insurance pool here, or this community pool. And then the question I will put to you is, if this person, this individual coming to join the pool, what will be your reaction? What will be your behavior towards a new participant coming to join the pool? I think on a very simple or general scale, it makes sense. The more the better. So having a new individual, new participant joining the pool is good news for everybody. The bigger the community, the lower the cost, and will spread the risk, reducing the risk as well. So, but on the other hand, if this person coming into the pool is an aged person, or maybe already diagnosed with some form of diabetes or a stage of cancer or any other thing you can imagine, just an example, as the coordinator of the pool, in the real world, I will call it the insurance company, you being the coordinator of the pool, how would you react to the news of this person joining? Are you going to tell him, now you're already diagnosed, the risk of you passing away is very high, so you will not join the pool? That would defeat the very purpose of the pool. Or are you going to consider him on some higher premium, taxing him a little bit more higher than the other participants in the pool, just to make sure he has some coverage, he is benefiting from the risk spreading from the pooling concept? What are your thoughts? How are you going to react to that? So think about that, and then you will start understanding in the real world what has actually happened. It could be as well just a very, very young kid joining the pool, which will also drive the cost down. So it could go either way, somebody with high risk coming into the community, or someone with very low risk coming into the community. That's just some thought for you, a scenario to provoke your mind. So let's continue with the risk now that you understand this pooling concept well. In this scenario here, I would like to make a disclaimer. So this is not representative in the real world. Here I try to highlight the ideology of complexity. You know, as an individual, as an insurance company or insurance pool of risk, and a reinsurance pool. For those of you who have been following along, when in the last episode when we discussed about the concept and the purpose of insurance, we understand that insurance companies themselves have attained a level of risk that they themselves in return need to be protected, and when they need to seek for coverage for protection, they go to reinsurance company in a much bigger pool or in a much complex pool of reinsurance pool. So this is just to highlight the complexity. At the beginning of this episode, I talked about two things to keep in mind: that increase in complexity, increasing risk. This is exactly what I'm talking about, and I put some examples here in a way to highlight that. So at individual level, what are some of the risks that you want to transfer when you join a community or a pool? If you're in debt, or you have some illness, or not having illness, but being worried of the situation or scenario of having illness or being disabled, or when you retire, how you're going to manage your retirement income and so on, or your funeral expenses, and there's much more. There's many things that you can put as risk. This is just a cross section of it. So that is at individual level. When you get to the level of insurance company, start thinking insurance companies beyond insuring individuals, they insure homes, mortgages, businesses, and much complex structures or organizations. This is a pool at a very different level. So with this level of complexity, the risk goes over the roof. Then when you move to the level of reinsurance companies, it goes even further. Reinsurance companies, they deal with scenarios like major disasters like hurricane, wildfires. So this slide is just to highlight the complexity. When complexity increases, the risk is very, very high, and very soon you start to hear words like insurable risk and non-insurable risk. For a better understanding of the complexity, I put these two structures here. It's very, very contrasting. So look at the smaller structure. If you own the smaller structure and say you upgraded into the big structure, so you grow in your net worth, in your financial value. But when it comes to participating in the pool of insurance, I guess our human nature, you would want to pay the participation fee or the premium for the smaller structure, but while owning the big structure. However, when it comes to the claims, you will want to be paid the net worth of the bigger structure. Meanwhile, you want to pay the premiums for the small structure. This is human nature, and but here is my challenge to you. Now, you moving from being that individual, I want to promote you to that coordinator of the insurance pool. If you are the coordinator of the insurance pool, how would you admit these two participants into the pool? How would you charge them? How do you determine how much you charge them for paying as participants in the pool? Will you charge them equally? You have to come up with formula standard ways of charging them. So, but here is the deal. It has to be equitable and fair, such that on the bigger or complex structure, it has to reflect the value of the building, and the smaller structure has to reflect the value of that building as well. Whether it is on the claim side or on the premium side, it has to be equitable. That's the whole point. For your further understanding of this complexity, imagine yourself being that coordinator of the pool. How would you ensure all these people are individuals, but how would you admit a chef, into the insurance pool. It's an individual, but at the same time it's a chef, so it's just not just a normal individual. How would you insure a pilot, somebody who likes to climb rocks, or a cancer patient? How would you insure a man and woman? Are they different, by the way? How would you insure a retiree or a newborn? These are questions I put to you. You are the coordinator of the pool now. How would you admit these people? Are you going to put them on the same scale, same balance? As an insurance coordinator, insuring a home, a residential home, a hotel, or a kitchen, does it sound like right? Do they have the same net worth, the same value, or the same risk? It's not just about the value, but also the risk that it brings. A hotel has much more net worth compared to a residential home, but the element of risk may be reduced. But when you introduce a kitchen here, how do you treat all of this? In a reinsurance pool, these are like real world perspective of complexity. Imagine the latest wildfire in British Columbia. Is it a possibility for one insurance company to insure all those homes that have been burned out? Now you start to see the purpose they need for every part of this community, whether it's the insurance, the individual, or the reinsurance company. They have different purpose, different roles at different levels of complexity. So it makes sense here that insurance companies come together in the pool of their own might in order to address a situation like the wildfires, the thousands of houses burned down. Just something for you to keep at the back of your mind while we'll be rounding up on this episode. As the complexity increases, it gets to some level where it's just not feasible, it's not possible. As much as we wish to have everybody in the community participate in the pool in order to spread the risk and reduce the burden on individuals, some of them are just unbearable. For example, insurance companies at some point, I just talk about the wildfires in British Columbia. It's just not possible. The insurance company will just go bankrupt if they have to cover all those houses at the same time. That's a scenario where these incidences happen on multiple homes in the same period. So paying out claims would render a single insurance company go bankrupt overnight. So understanding the pooling at that level within insurance companies, seeking insurance from a reinsurance company, it brings a pool of many insurance companies together. That way they can be able to address a disaster of that magnitude. But coming to individual level, you hear words like pre-existing conditions or exclusions. These are insurable risk versus uninsurable risk. Insurable risk will want to bring you or admit you into the pool as an individual, but admitting that you already have some conditions existing. If you are diagnosed with the diabetes or cancer, but you still survive, you can handle yourself personally, you don't need an assistant for some body assistance, you can still be admitted into the pool, but keeping away those pre-existing conditions. Meaning that if in the event of anything, if you were to pass away as a result of those pre-existing conditions, a claim will not be paid. And that's a mutual understanding before you get into the pool. This is some of the things that we're going to get to an episode where we'll be talking about perceptions. So we'll understand a lot of these myths and clarify some of them. So, but here's where pre-existing conditions come from. You know that this condition is just not insurable. but you still need to be part of the pool. Or they will insure you and exclude a couple of those scenarios, those risks from the general pool. Meanwhile, you will be admitted into the pool. So I would like you to, if you had some worries around these conditions, pre-existing conditions, exclusions, or why some claims not paid, some of the reasons, most of them would revolve around these issues here, which are spelled upfront before even admitting an individual into the participating pool. The key takeaways from today's episode is two things. You should consider spreading your potential risk to any pool of your choice before the risk becomes evident. You don't have to wait for when you'll be sick. It will be too late to get into the pool. And complexity increases the need for a pool. So while you're young, the earlier you get into the pool, your cost will be cheaper, reduced. And before you start growing and making a family, as the family grows, increases, your complexity increases and your need increases even further. So too is your cost. Thank you for watching up to this level. Just a side note, I got some comments from some people asking why I didn't mention about car insurance. A lot of people want to hear things about car insurance, but here's one thing I want to assure you. If you understand the pooling concept, it's the same across any insurance. I tried to make things general from the beginning. This is Life Insurance Awareness Month, but I wanted to address things from a general perspective. So when we understand the concept of insurance, the concept of pooling, it's easy to apply in any one of them. I have the same issues. All of us are drivers. Car insurance are really high and people complain a lot about those. The concept is the same. It's the same pooling concept. I would not want to go much into that. I can talk about that on one-to-one. By the way, it's not part of the Life Insurance Awareness Month. It doesn't mean that I cannot talk about that, but on a side note, we can take that aside from here. So I want to thank you for continuing to support and watch. Put your comments in the questions in the comment section so that we can respond them. Upcoming, our next episode will be on the types of insurance. So stay tuned and watch out for the next episode. Thank you.